Okay, Chris. Hi, Chris. Is there a strategy that matches the SPX?
The answer to that question is most of the tax loss harvesting engines that we referred to offer direct indexing and will allow you to try and track the S&P 500. We very specifically don't have an S&P 500 index because S&P already has one of those, and we didn't see much value in creating another one. However, we do have a large cap core index that correlates at like a 0.99 to the S&P that's delivered hundreds of basis points in alpha relative to the S&P. And those are the kinds of strategies that we like to deliver. But yeah, in answer to this question, that it would be easy to find one of those, but it's not one that we're able to offer.
Hi, Elaine. Are you using ADRs and or locals in global strategies?
So the answer to that question, Elaine, is in our global strategies, the particular sleeve that we're using uses US, traded ADRs just due to the difficulty for US financial advisors in executing in local, ordinaries in other markets. A lot of the custodians make that very difficult to accomplish. So we prefer using ADRs. However, we have strategies that we haven't discussed that do trade in locals in case you are offshore or have a preference for trading in ordinary locals. We do have strategies that we could line up to create a blended portfolio for you that use them.
Yeah, I would just say to that tax loss harvesting is such a big thing in the United States and much less of a thing in Europe. So yes, we do have ADR strategies and can do local and currency work as well.
Hi, Abadami. Good day. How are your stocks weighted?
So each of the different component strategies that we put into these blends has a slightly different weighting mechanism. Some of them are weighted according to risk-adjusted momentum, and some of them are weighted according to equal weighting, and some of them are weighted according to other portfolio optimization factors. So every one of them has a kind of a different weighting mechanism, which in a way actually provides yet another kind of level of diversification.
Yeah, that's probably a good time to just reference that kind of back to the index one and back to the BX platform. BX works with about 22 different strategists. And so each one of them has their own methodology and weighting system. And then index one has more beyond that. So they're all, the nice thing about it is everybody approaches it differently. And then what we do at the platform level is bring them all together and then blend them into portfolios such as the global tax loss harvest portfolio.
Chris has a follow-up question around fees.
The fees work for these models. The sticker price, we call it, is 25 basis points. And then to run it through a tax loss harvesting engine like Alpha Athena, the all-in cost would be 30 basis points. I don't know. We feel like if you can generate several percentage points over a market cycle of alpha and several percentage points of tax loss harvesting, that's how that works. In those firms, through the Alpha Athena tax loss harvesting engine, we can pretty much get direct access for clients and advisors at Schwab, Fidelity, Pershing, and other key custodians.
Hi, Rakesh. He asks, are there tradable products?
So the answer, I think, to the question is everything that we're talking about today is specifically to everything we're talking about are individual stocks. BX and Index One also have indexes that contain just ETFs. So everything is tradable on the major stock exchanges, and you can either get signals and execute trades yourself, or you can find the different strategies at different tech stacks or TAMPs or trading engines.
Yeah, and also add from Index One's perspective, there are currently 6 ETFs that are tracking our indices outside of the indices that we discussed on this webinar today. But yeah, that's just a little tidbit if you're interested. We have a follow-up from Elaine. What level of losses are you able to harvest in your portfolios?
Elaine, that's going to be really highly dependent on market conditions at any given kind of point in time. We've run some stress testing. We've run our portfolios through a number of different tax loss harvesting engines. I mean, generally what you see is a few hundred basis points, 300 basis points maybe in the first couple of years. The one drawback to the tax loss harvesting strategies is over time, assuming the market is rising, there become fewer and fewer losses to harvest. But in those front years, it's not surprising to see examples where even in a good market, you can generate 300 or 400 basis points in tax losses.
And also some variability. So when you go into the tax loss harvesting engine, you can set your loss parameters. So if you want to take more losses, but potentially even smaller losses, you can increase the percentage of losses you might take in any given year. So there's some customization at the user level to determine what your turnover is, which will ultimately play into your maximizing of losses.
We've got another question in from Elaine. What is the minimum size for client portfolios?
So Elaine, that's going to be highly dependent upon if you're in a full share or a fractional share environment. If you're in a full share environment, we'd kind of have to go through the math to see what's the minimum size that would be most likely to replicate the model as closely as possible. Obviously, in a fractional share environment, you can really trade any size. But our general thinking is, if you're in a full share environment, $50,000 account, you're probably going to have pretty substantial tracking error trying to hold 350 different stocks versus the model. Whereas $1 million account, it's probably going to work. The nice thing is that the preference for executing this kind of strategy is generally going to come from those with larger account sizes to begin with. So that's generally not going to be an issue. But yeah, in a full share environment, you're going to need a much larger account for it to make sense. Whereas we're indifferent to it. If you want to do a $20,000 account in a fractional share environment, that's fine. It's just you're not going to realize very many losses.
Do you help your clients reduce a large concentrated position over time and manage capital gains?
Elaine, that's a great question, and that's one of the best use cases for a tax loss harvesting strategy. In other words, your account is half one stock because you worked at that company, and it's half diversified, and that's a nightmarish portfolio, or even 70%, whatever it is. So the idea is to marry the tax loss harvesting strategy with gradually taking the capital gains in the large embedded kind of position that you have. And our friends at Alpha Theta and Artha and all the different engines that you can execute for that do tax loss harvesting, you can set the parameters on that and say, look, I want this position to be down to 15% of my portfolio within the next 2 years, and it'll try to maximize your, try and make sure the entire portfolio does as closely to the intended target as possible while managing that, eroding of that big position down to a more manageable size.